Hi, I'm Badu from FreeFinCal. In this video, let's talk about the PE ratio of a mutual fund and how to use it. So the PE ratio of a stock, as many of you know, is the ratio of the current market price divided by the earnings per share. So it is a measure of how the market values the stock compared to its earnings per share. If the PE is too high compared to the a particular sector compared to the category peers, then the stock is likely to be overvalued. If the PE is lower than the category peers, then it's likely to be undervalued. Of course, it's only one particular measure of value. There are others to worry about. Then there is the PB ratio of a stock, which is the price to book value. The book value is essentially the value of the business as perceived by the company in its own balance sheets. And the PB essentially tells you what is the price relative to the value of the business. Again, a high PB ratio would mean overvalue and a low PB ratio would be undervalued relative to category peers. The third ratio that's popular is the dividend yield, which is a measure of how much how much of the company's profits is being paid out as dividends. So for a stock, these are common metrics to measure value, and usually in a value investing strategy, one tries to look at stocks which have a low PE ratio, low PB ratio, high dividend yield. Essentially, the company tends to give out the profits as dividends, and so there are also other ratios like price to sales and so on, low price to sales and so on. But you can do the same thing for a mutual fund as well. You can calculate the weighted average PE of a mutual fund portfolio, weighted average PB, and dividend yield as well. And we are going to find out how to use this in this video. So the first thing, before I begin, let's make it very clear. Just like you use the Nifty PE, you can't use the PE of a mutual fund. Just like when you look at Nifty PE and you say 25 is overvalued, 10 is undervalued, and so on. That kind of market timing cannot be done with the PE of a mutual fund. The PE, PB, and the dividend yield of a mutual fund is representative of the investing style of the mutual fund. You may have seen something known as a style box in value research, where you have a 3 by 3 grid with a black coloring, which tells you whether it is a growth fund or a value fund or a blended fund. It's a growth fund investing in large cap stocks, mid cap stocks, small cap stocks, or maybe the coloring can be in multiple boxes and so on, as in Morningstar does. So the PE, PB, and dividend yield of a mutual fund are used to find the investing style of a particular mutual fund. Of course, you should also look at those metrics and compare it with a category. So relative to a category, and if you should also compare one category's typical PE with the other category's typical PE to get some measure of how the fund manager is handling the portfolio. So the first example is going to be rather extreme. This is Motilal Oswal Focus 25 fund. This is a large cap fund, and I've plotted the PE history of this fund. This is shown in green, and I have shown the PE history of HDFC Index fund, which is a Nifty 50 index fund as well. That's just to tell you the Nifty 50 PE it's a proxy for the Nifty 50, right? And you can see clearly that the Motilal Oswal fund has a PE significantly higher than that of the Nifty 50. So that's an indication that it's a growth style mutual fund. Typically, they look for in a growth investing, you look at stocks which have got a higher PE relatively. Again, if you look at the price to book value, you can see the orange is that of the fund, and the blue is that of the index. You can see it has got high PB, again indicative of a growth style investing. And the dividend yield typically for a growth style will be much lower than that of the index, and that's what you see here. The fund has got a very low dividend yield. So essentially, it will invest in companies which will take the profits and reinvest back into the business, and that's the reason the dividend yield is low. And if you look at the market cap of the portfolio with respect to the Nifty, you can see that the market cap is significantly lower, although this is a large cap fund. So the fund manager is focusing on within the top 100 stocks of the Nifty, it's focusing on um, uh, large caps, but they are not as large as the stocks in the Nifty or the Sensex. So they are in the lower end of the large cap and they are growth stocks. So that's the kind of investment strategy that the fund manager has. So these are the kind of inferences that you can gain. Of course, these kind of portfolio history, you may be curious where I've got it. This is from a paid software. You cannot, retail investors possibly cannot have access to this. Of course, they can use it. They can check the portfolio value using value research, or they can look at the fund fact sheets, Morningstar, to get some idea of how the value changes month on month. So today I had talked about ICICI Value Discovery and also Quantum Long-Term Equity and asked if it's time to exit these funds. This is a follow-up on the video I already made, what is wrong with these two funds. And in that video, I talked about how these funds have a value style, kind of value investing style of managing the portfolio. Looking at the style box of Morningstar and Value Research, today's post I have used this market cap history, PE history, and so on to look at the value style of these funds, and that's what we look at next. So what you see here is the PE, PB, dividend yield, and market cap of all the value-oriented funds, and you can see among these funds, Value Discovery, Templeton India Value Fund, and Quantum Long-Term Equity have the lowest PE, lowest PB, lowest dividend yield, and their market cap is somewhere in the middle or towards the lower end. So as of now, these are the most value oriented among the value oriented category. That all the others seem to have a kind of a blend style, or maybe even a growth kind of investing. This is the reason I asked that question. Will you invest in a fund if the fund says I'm a value oriented fund and they adopt a growth oriented fund just to make sure investors don't leave the fund? I mean, when I ask it like that, people say, no, investment mandate is very important. But when their own returns suffer, they will not be patient. That's the problem. When you want a value-oriented fund, you must be patient. It will not perform at all times. If you want diversification, then all your funds should not be performing at all times. Value fund will underperform, growth funds will outperform, then the reverse will happen. That's when you have portfolio stability. So you should understand the basics of portfolio management before choosing something like a value-oriented fund, contra fund, or a dividend yield fund. If you don't know portfolio management, well, you must learn it. While you learn it, at least choose a growth-oriented fund. More or less, you will be happy reasonably. Of course, you can ask, why can't I use only growth-oriented fund? Yes, you can. That's up to you. There are many ways to go from point A to point. So this is the PE history of ICICI Value Discovery, which is black line. The red line is Quantum Long-Term Equity, and the blue line is the HDFC Nifty 50 Index Fund. Notice that typically the red line has been kind of lower than the blue line, lower than the PE of the Quantum Long-Term Equity Fund has been lower than that of the Nifty, and that's a hallmark of a value-oriented fund. It went up during what is that? Towards the end of 2018, I think, and then it quickly was brought down. And if you look at ICICI Value Discovery, there are periods here during the start of the bull run. ICICI Value Discovery's PE started increasing and then it brought it down. But what happens is, because it held those high PE stocks for a while, I think the return in that period was kind of for that window was higher. And if you look at the let me just, I don't know where I put it. If you look at the rolling returns for 3 years, and if you can see here, during that period where it held those growth stocks, the 3-year outperformance was significant, and then it fell down. And then when the PE went down below the Nifty, then the 3-year outperformance came significantly lower than that of the Nifty 500 here. So generally, I mean, you can see here that the PE history of these funds are significantly different than that of the Motilal Oswal fund. So that's a character. This is an extreme example of a value-oriented category. Of course, when you have a blend category, then it's very difficult for you to say whether it is this or that, and how do you define it as blend. You need numbers, you need quantitative measures to identify a blend. That's what the portals do. But it's still I mean, at least in the extreme categories, when you want to build a diversified portfolio, you want two extreme kind of funds held together. So that makes sense. Again, in the price to book value, you can notice that PB of the quantum long-term equity has been always lower. The red line has always been lower than that of the green line, and the black is the ICICI value discovery. Notice at some point during the start of the bull run, it shot up and then it quickly corrected, and then it was remaining good. So there was a period where it became a growth kind of fund, and then they made sure it to make it style pure. They made it more value style. So these are good value-oriented funds, mind you. There's no problem there. The problem with us, we are not patient enough. So that's the dividend yield. You can see that the dividend yield of the red line is typically higher than that of the blue line. The black line, which is the red line, is quantum. The blue line is Nifty 50. The red line, the black line is the ICICI fund, and that's also been more. Sometimes it's been higher, but sometimes it's been lower. But it's not been consistent in that sense. But quantum has been a lot more consistent, at least since 2013 onwards. So and finally you can see the market cap history. When notice here also the market cap history is lower than that of the Nifty 50. So they can invest in mid cap stocks as well. So that's another reason why the market cap history is lower. But notice how the market cap history of the Nifty 50, the blue line, suddenly zoomed, somewhere in end 2016 or so. And that is the reason why many of these funds, these value funds, are unable to beat the benchmark. Their benchmark is Nifty 500, which would be similar to this, or Nifty 50 or Sensex. Some of the stocks started shooting up, and because of that, the Sensex moved up, and these value funds struggled to beat the benchmark because of a result of a few stocks in the Sensex or the Nifty. So I had talked about what you should do with these two funds in the article. Go have a look at that. But that's how you essentially use the PE/PB dividend yield of a mutual fund. You use it to understand the investing style. It will help in the extreme cases, but if it's a blend, it's kind of hard to spot. So that's what I want to say in this video. Bye bye.